afternoon, everyone. This is Rob O'Dell, co-founder of Wheaton Wealth Partners in Naples, Florida. Hope you all had a very good Thanksgiving and holiday break. We're excited about today's webinar. Before we get going, I want to give a few items of business. On the right side of the screen, you'll see a panel. In the panel, there's an area where you can ask questions, and we will provide answers. And our plan today is to have Brian and myself go through the material. But as we go through it, you can write a question, and if it's applicable, we'll answer it on the spot, or we'll wait to the end, or maybe we'll be covering that material that your question pertains to. This is the last and final webinar for 2015, and it's always fun to be able to do a webinar with someone who's a lot of fun to be around, who's knowledgeable, and with a great sense of humor, and that's Brian Eisenmenger. Brian has done the tax planning webinars for the last 2 years. This is his 3rd year of doing it. Give you a little background on him. He's a CPA and partner at Mathieson, Moyski, and Austin, located in downtown Wheaton. Brian speaks frequently on income tax planning and estate tax planning, and he trains other CPAs in ed credits. He's a graduate of Eastern Illinois in business and Masters of Science at Northern Illinois University. Now, something that Brian and I share in, and many of you know this, is that we're suffering Packer fans. And Thanksgiving was great until about 10 o'clock at night. I think both Brian and I started, cried ourselves to sleep. But Brian, thank you for being here. We're excited for the presentation, and take it from here.
All right. Well, thank you, Rob. I appreciate it. Well, good afternoon, everybody, or if you're on the West Coast, good morning. Welcome to our webinar, and today we're going to be talking a little bit what I think of back to the future, and that's we're going to talk about tax saving strategies that you can implement right now so you can save money on your taxes on April 15th. One of the things I've always liked, and John, I'm going to need you to come in here because I'm hitting the button to transfer the slide and it's not moving. So not sure how this is going here. It won't. Sorry about that. That handout. There you go. What did you hit? The up and down. Okay. I've always liked. Sorry about that, folks. I've always liked what Arthur Godfrey said, and he said that I'm proud to be paying taxes in the United States. The only thing is I could be just as proud for half the money, and I do find it very interesting that right now, as we're hearing a lot of the politicians talk, they're all talking about how they want to save money or lower everybody's tax rates, yet bring in the same amount of revenue. And I've always wondered how they're not going to do that. And we've heard some interesting tax plans out there from one candidate who has said they would simplify the tax code from the 75,000 pages or wherever it is right now to 3 pages, which I think would just be about impossible to do, but they say they can do that, to a plethora of other plans out there. But they all have one thing in common, and that one thing that they have in common is that they want to lower tax rates across the board, simplify the tax code, and they say that they'll bring in the same amount of revenue, which will be interesting to see if they can do that, whoever gets elected. Now, we're talking about 2015. How can we avoid taxes for 2015? And if you take one thing away from this webinar, it's going to be these 3 things. Now, it's the 3 legal ways to avoid paying taxes. I've always liked the one joke that's out there about how to have $1 million and not pay any taxes. And that is, first of all, make $1 million, and then the second thing you do is not pay any taxes. Well, that's not legal. So we're going to talk about the 3 legal ways to avoid paying taxes. And the first way you can do that is, first of all, to lose money. If you lose money, most likely there's going to be a tax deduction there for you. So there's one way that you can avoid paying tax. The second way you can avoid paying tax is to give it away. And what I mean by giving it away is giving it to a charity. So giving it to your church or synagogue or whatever it might be, if you give it away, that will be a method for you to avoid paying taxes. The third way is to defer it. And so that's where you take your income and say, I'm not going to take my income now, but I'm going to push it off into the future. So you defer it to a future year. So those are the three legal ways. If you take one thing away from this webinar today, take away this, is there's three ways to avoid paying taxes: losing money, giving it away, or deferring it. Now there's a fourth way that you can use to avoid paying taxes as well. Unfortunately, this fourth way won't save you any money for 2015, but it's a way to avoid paying taxes, and that is to Roth it, and that is to have a Roth IRA. A Roth IRA, of course, is something that you can do, that you put money into, and when you go to take it out, after it grows and grows and grows, you can take money out. Given that you've met all the requirements that a Roth IRA has, you can take it out and not pay any tax on it. The unfortunate thing about a Roth IRA is, while it's a great way that you won't have to pay taxes in the future, it's not going to save you any money in taxes currently. So those are the three legal ways to avoid paying taxes. Now, there's various strategies that we believe that you can implement now that will save you, that you can implement now. One is gifting right now, and that'd be gifting to a charity. Another strategy that you could do is look at the idea of converting to a Roth IRA, and we'll talk about things that you can consider for converting to a Roth IRA. We'll talk about charitable strategies. And then we'll also talk about ways that you can avoid the net income tax. Now, the other way that you could have done is you could have bet on the Bear-Packer game, and you would have lost money on that. And of course, Rob, I think you put that strategy. I don't know if you put that there, or did John, one of your cohorts, put that last bullet point there?
It was me. It was me, Brian.
It was John. Great to go, John. We appreciate that. All right. So what our next slide shows here is the tax brackets for ordinary income. And those tax brackets for ordinary income, you can see there, the 10% bracket, 15, 25. One of the things I'd like you to see on this, and that is if you take a look at the 25% tax bracket, that's where we start seeing the marriage penalty come into play. If you take a look at that in the single bracket, you have the single rate for the 25% tax bracket start at $37,451, but then it ends at $90,750. Now, if you go to the married filing separate column, that last column all the way to the right, the 25% tax bracket ends at $75,600. That's married filing separate. If you go to married filing joint, which should in theory be double what the single rate is, you see that it ends at $151,200. So at the 25% tax bracket, that is where the marriage penalty starts kicking in. And we always say another way that you might be able to save on taxes, maybe not the most favorable way that you want to use, and that is to get divorced from your spouse, because if you're single, that would bring in a lesser tax rate for you. But again, that's not necessarily something that we can do. And John,
well, I consider that a wealth reduction strategy.
A wealth reduction strategy. That's right, because while you may save money in taxes, and John, I got to tell you, the keyboard here has ceased to work for me to advance the slide. I don't know what I did to have done that. So I don't know if you can come back in here and help me out here. Sorry about this. I did something wrong.
Did you hear about the new Barbie coming out? It's the divorce Barbie.
No, I did not hear about that.
It comes with half the Ken stuff.
So what did you hit there?
Down.
Okay. Okay. There we go. It didn't work for me before, but okay. And I'm going to hit up. Okay. So here we see on the next slide the tax rates for ordinary and qualified dividends, or excuse me, for qualifying dividends and for long-term capital gains. And what you see here is that if you are in the 0 to 15% tax bracket and you have qualified dividends or long-term capital gains, your tax rate is 0%. Then, if you're in the tax bracket that is above the 15% tax bracket to the 35% tax bracket, your tax rate on ordinary dividends is going to be 15%. And then if you're in the highest tax bracket of 39.6%, your tax rate is going to be 20%. So just something to keep in mind, that qualifying dividends and long-term capital gains give you favorable tax rates in regards to ordinary income. All right. Now the next strategy that we like to talk about is gifting. And what I'm talking about in this particular strategy is not gifting to a charity per se, but gifting to children and loved ones. So what we have here is for 2015, the annual gift tax exclusion is $14,000. Now this gift tax, this gifting of $14,000 will not do anything to provide you a tax saving strategy this year. It's not like you get a $14,000 deduction for giving money to a loved one. But what it does do is it transfers assets and transfers income to someone who may be in a lower tax bracket, like a child. So for 2015, the annual gift tax exclusion is $14,000. So what that means is that a husband and wife can give $28,000 to their favorite person. Now, Rob, I know you'd like to think that's you, Rob, but it's not you. It's going to probably be their children. But then what happens if you give more than $14,000 to someone? And this is what I always consider the biggest urban tax legend in the history of taxation, because what everybody gets concerned about is that they give more than $14,000 to someone is they're going to have to pay the gift tax. And that's not what happens. What happens is if you give more than $14,000 to someone, you have to fill out a gift tax return. Now, just because you fill out a gift tax return, which is a hassle to do, but if you fill out a gift tax return, it does not necessarily mean any gift tax is owed. In fact, gift tax won't be owed until you give well over $5,340,000. When you give away over that amount, then you have to worry about paying gift tax. But if you just give $20,000, for example, to your son or to your daughter, that means you'd have to fill out, and it's just one person doing this, not a husband and wife, but let's say it's just a father giving or a mother giving money to their son or daughter. Then what would happen is they'd have to fill out a gift tax return, but no gift tax would be owed until they have given away that well more than $5 million. So again, not something to be concerned about, but it is a concern that a lot of people have, is that as soon as they give $14,000, they're going to have to pay gift tax, and that's not the case. Now it's interesting because the courts have ruled recently that a child can deduct medical expenses and real estate taxes that are paid by the child's parent. So that means you as a parent, you can pay the medical expenses, you can pay the real estate taxes for the child deducts it on their tax return, and that payment is considered a gift to the child. And that was a tax court ruling that came down in 2010. So again, something that you can do for a child if you so desire is to give them the money to pay their medical expenses, to pay their real estate taxes. You do not get that deduction, but the child still gets that deduction. That brings us to the subject of the kiddie tax. And what the kiddie tax does...
Can I interrupt you for 1 second there? The question came in, does the parent have to write the check directly to the, let's say, their real estate taxes to the county assessor, or can they give it to the child who writes the check?
Well, in either way, you could do it either way. What it ruled back, let's go back to that slide. What happened in that particular court case is that the parents had made the medical expense payments. The parents had made the real estate tax payments on behalf of the child, and that counted as a gift to the child, even though they did not make the payment to the child. They made it to the local assessor. They made it to the doctors. So it still counted as a gift to the child, even though the payment wasn't made to the child. It was made to like I said, the assessor and the doctors in that case. Does that clear that up?
It does. Thank you.
Okay, sure. So that brings us again to the kiddie tax. And what the kiddie tax does is it taxes unearned income of a child at the parent's marginal tax rate. What we've considered doing is we want many times to shift income from a parent who earns a lot of income to a child who earns little income. Well, what the kiddie tax does is the kiddie tax does away with that strategy. It does away with that loophole. And what it does is that the child gets taxed at the parent's marginal tax rate. And this happens no matter whether that child can be claimed as a dependent on the parent's return. So, for example, if a child is under the age of 18 and has quite a bit of income, perhaps, that income is going to get taxed at the parent's tax rate. And this is going to include children who are over the age of 18, but they're under the age of 24, who are full-time students in college. So again, those folks would be subject to the kiddie tax. Now, if a family has a child in college, depending upon their income, it might make sense for them to forego claiming that child as a dependent if they make too much money. And the reason why they would do that is in order to claim the American Opportunity Credit. The American Opportunity Credit is a very valuable credit for having a child in college, and its worth can be worth up to as much as $2,500. So let's use this example. As we've got Ken and Barbie. Ken and Barbie have $180,000 in wage income, and they've got, which happens to be the maximum amount where the threshold for the American Opportunity Credit phases out. They have $30,000 in qualified home mortgage interest, and they've got $20,000 in charitable contributions. Now they've got one child, Megan, who's a freshman in college, and Megan has $6,000 of interest and $13,000 of long-term capital gains. Now I know what you're thinking here. At least you're thinking this. I thought of this at first as well. What kind of child has $6,000 of interest and $13,000 of long-term capital gains? And you know, I'll grant you that in terms of the $6,000 of interest. But if you have the $13,000 of long-term capital gains, that's something that could very much happen, because you might have had a child that was gifted stock, or the stock was purchased for them when they were a small child, and that stock has grown and grown and grown, and now they're 18, 19, 20 years old, and it's time to sell that stock. That stock could have significant long-term capital gains. So again, that's the realm of this particular example. So here we have on the left, the two columns on the left, that's if we're going to claim Megan as an exemption. So what happens is if you claim Megan as an exemption, Ken and Barbie have $180,000 of adjusted gross income. You see their mortgage interest, their charitable deduction that they're going to take, and their personal exemption, which are going to be $11,850. Their tax is going to be $21,433, and there's going to be no American Opportunity Credit. We have Megan, who's going to be taxed on the interest at their parents' tax rates, the long-term capital gains, which is going to be taxed. She's going to get a small standard deduction of $1,000. Her tax on that is going to be $3,087. So the combined tax in that example is going to be roughly $24,500. But what happens if we don't claim Megan? Well, if we don't claim Megan, the one thing that changes in Ken and Barbie's tax situation is that their personal exemption goes down. So their personal exemption goes down from $11,850 to $7,900. Now that, of course, is going to cause their tax to go up. And that tax is going to go up from $21,433 to $22,408. So it's going to go up by roughly $1,000. But let's look at what happens on Megan's side of the coin. On Megan's side, she's going to have $19,000 of adjustable gross income. Because she could be claimed as a dependent on her parents' tax return, she's only going to get $1,000 of a standard deduction. That brings her tax to $3,087 still. So that doesn't change. But what does change is by not being claimed by her parents, she's going to get the full value of the American Opportunity Credit. And so that lowers her tax to $587. So the difference in this example by not claiming is we've got $24,500 of net tax if they claim Megan. If they don't claim Megan, their combined tax is going to be just shy of $23,000. So there is significant tax savings, or $1,500 worth of tax savings to be had here by not claiming Megan as a dependent. Now this,
so Brian, if someone here call has an adult child or grandchild who, let's say, is 24 years old and has virtually no income because they're a professional student or they're getting their master's, doctorate degrees, what have you, it would make sense for them to make gifts of stock to them to fill up the 15% bracket. Is that correct?
Absolutely, that would be correct. Because again, we would want to take as much as we could in the 15% tax bracket for that child. And again, that child, if they have income, they're still going to qualify perhaps for the American Opportunity Credit, depending on their income. So yeah, I think that makes a lot of sense. Does that answer your question?
It certainly does.
Okay, good. Okay, so the next question that we come to is Roth conversions. I think Roth conversions are just a great idea because, again, we don't necessarily save on taxes today, but we do save on taxes tomorrow. And one of the things is there's a lot of questions that we need to ask, a lot of things we need to consider if we are doing a Roth conversions. And one of the first thing is, what do you think you can earn on your retirement accounts between now and retirement? Because the more you can earn on those accounts, the better it would be to have it in a Roth IRA. The idea being that if we earn a lot of money in a Roth IRA, or I guess when we go back to the whole idea of taxation of IRAs in general, is that IRAs do not get capital gains treatment. It's all going to be subject to ordinary income tax. So as a result of that, if we have a lot of money that we think we're going to earn in our IRAs, if we can convert that to a Roth IRA, it means no tax to be paid at ordinary rates. The next question to ask is, what do you think your tax rate will be when you retire? Most people are going to be in a lower tax bracket when they are in retirement. They might go from the 25% tax bracket down to the 15% tax bracket. But that's not true of everyone. Depending on pension plans and retirement plans that you have and how well someone has saved, their tax rate might actually be the same because IRAs, again, are taxed at ordinary rates. But again, it's something that you need to consider is, given your income that you have during your earning years, how much do you think your income will be during retirement? How much will you be pulling out of your IRAs? And what will your tax bracket be when you retire? Also, very important, do you have the extra funds to pay the tax on a Roth conversion? If you don't have the extra funds to pay right now, then it doesn't make sense to do a conversion. Let's see, the next one that we want to ask, if we can have it come up. There we go. Is there a significant chance you will have a low-income year in the near future? So what that means is right now you might have had a very high-income year for 2015, but if you look ahead and say that 2016 is going to be a low-income year, 2016 would be a better year to convert to a Roth IRA, especially if you believe that low-income year is going to be an anomaly. So, for example, if you're having a bad year this year for 2015 or a low-income year this year, this might be the year to convert to a Roth IRA, convert some money to a Roth IRA, as opposed to doing it in a future year where your income is going to be higher. The other question, the next question to ask is, will you need retirement money to live or meet financial needs before your expected retirement date? And the reason why this is important is because if you do, then your Roth IRA suddenly is not non-taxable. You could be taxed on it if you are if you take it out before before the age that you can take money out of an IRA. Also, the question is, when do you plan on retiring? Do you plan on retiring in the next couple years, or do you plan on retiring 10 or 15 years out? And the reason why that's important is because money that you convert to a Roth IRA has to be in that IRA for 5 years. All right, now other questions to ask. Do you have any losses that you're carrying forward on your tax return? Because if you maybe had a bad year in 2014 where you're carrying forward a net operating loss, that would help mitigate some of the income from a Roth IRA conversion. Also, have you made any non-deductible IRAs contributions in the past? The reason why that's important is because when you convert to a Roth IRA, that non-deductible portion of your IRA is going to have to be considered. And of course, on the non-deductible portion, that would not be subject to income tax. Other things to consider. Will the conversion have an effect on the alternative minimum tax? We don't want to have a situation where you're paying unnecessary taxes because of a Roth conversion. Also, if you're in retirement and you're converting to a Roth IRA, is that going to cause your Social Security benefits to be taxed? Also, how is that going to affect the deductibility of medical expenses? Right now, without the Roth IRA, you might have been able to deduct your medical expenses, but with converting to a Roth IRA, those medical expenses all of a sudden might not be deductible. So again, you want to consider your whole tax situation as you're doing this. Also, and I know, Rob, this is something that you guys are very big on, but should you set up Roth accounts, should they be set up separately as the type of investment? And Rob, I'll let you comment on this in terms of investments, but typically what you want to have is your Roth IRA to be very aggressive, and you want it because you want to grow as much as you can, because obviously if you're having it grow as much as you can, then it comes out tax-free. That's much better than to have it maybe in something more conservative. I don't know if that's something you'd agree with, Rob, or not.
Fully agree with that, and something that we will do often is Roth at the beginning of the year, and the reason why is, and maybe you're going to get to this, is the Roth IRA allows you to have a mulligan of approximately 22.5 months. So on January 2nd, first business day of the year, we can convert to Roth and have separate strategies and separate accounts, and you pay tax in the year that you convert, so it'll be 2016, you pay the tax, but you have a horse race between then and October 15th of 2017. Why October 15th? It's 6 months after the time you're supposed to file your tax return, or last possible day to file your tax return. And if one of the accounts does poorly, you can send it back to a traditional IRA and have your taxes be made whole. And so it's a very common strategy that we incorporate with planning with our clients.
That's right, and it's a great, like you said, it's a mulligan, and it's a way, again, because you don't want to have to pay taxes unnecessarily. And if you convert to a Roth IRA and that aggressive investment falters, well, you don't want to pay taxes on that, so this gives you a way to do over without having to pay tax on that.
Right.
All right, so who are candidates for Roth conversions? Well, younger taxpayers. They probably have the most to gain because of the tax-free growth and the amount of time they have for that tax-free growth. Also, seniors who want to reduce their required minimum distributions. Those would be good candidates. Also, people who want to use the Roth conversions as an estate planning tool to reduce their estate. Now, this is going to be for really, really high net worth people, people who've got estates in excess of like $11 million, let's say, because obviously at $10 million some odd $1,000, almost $11 million, that's when the estate tax kicks in, and it kicks in at a rate of 40%. So again, if you have, it might be a way to pay some tax now and reduce estate taxes in the future. Let's see. Who else are candidates? People who are experiencing temporary employment or business setbacks, because again, if they're having a low income year and it's an anomaly, they can take advantage of that, and they can convert and perhaps pay no income tax or a very low income tax. Also, taxpayers who expect tax rates to increase in the future. That's a tough one, and that's none of us have a crystal ball. We have all the presidential candidates on one side who are saying that they want to lower taxes across the board, but yet we know that we've got this high insurmountable debt, and so we wonder how are they going to be able to do that. And so again, it's really where your preference is on and who you believe in where tax rates are going to go. Let's see. So this is just a strategy that can be used for Roth IRAs. It can actually be used for a regular IRA as well, but I think it's much more powerful for a Roth IRA. And that is, we've got a grandpa. And we've got a grandpa, and he names his 3-year-old child as the beneficiary of his Roth IRA. And grandpa passes away. And at the day that grandpa dies, the account has a balance of, let's say, $10,000. Well, then what happens is that we have the account. We're going to assume that it earns 7%. And then starting at age 4, the grandchild is going to have to receive an annual tax-free gift, that's the required minimum distribution from the IRA, from grandpa's account, and it's going to start at $134 per year. And it's going to grow to $290 by the time that child reaches age 18. At that time, the account is going to have grown at 7%. It's going to have grown to just under $23,000. And what can that money be used for? Well, a wonderful way to pay for college. So again, something to consider for someone to consider. Now, if the grandchild only takes out the required minimum distribution by age 65, meaning that when they are age 18, they let that money go, then what will happen is they'll receive annual payments that will total just shy of $70,000, and it's going to have an account balance at that time, at age 65, of $300,000. And that $300,000 is going to be there tax-free for them to use at their retirement. So again, now this gets into a whole lot of planning techniques, because the question then is, do you want to have that child be the beneficiary, or do you have a trust where the child is the beneficiary of the trust, and that way you can dictate from the grave when that child takes the money or what it's used for? But again, this is something that can be considered. And again, we're using the example of a Roth IRA here because the beauty of it is the money comes out tax-free for the child, but this can also be used with a regular Roth, or excuse me, with a regular traditional IRA.
Brian, if I could add a little color on that. This morning
Sure.
I had a meeting with an individual, and in 1998, I believe he converted, and when he converted his IRA, which was large then, everyone told him he was crazy. Well, today he's very grateful that he did make the conversion, because he's over 70 and a half, and if he hadn't done that, he'd be having to take required distributions when he doesn't need them. The planning strategy we put into place here for the grandchildren is having trusts set up. So irrevocable trusts that are dry, they're not funded right now, but when this individual and or wife pass away, and the second one of them passes away, the 9 grandchildren will receive a very sizable decedent Roth IRA administered by a trust for the rest of their lives, and they have incentive clauses in the trust. It's really something neat, but definitely want to look at a trust, and even individual trust for the grandchildren because of the age issue.
Yeah, so there you go. I mean, that's, and again, the trust allows you to control it from the grave. So yeah. That brings us to the idea of looking at some charitable strategies, and one of the strategies that's been out there for a couple of years, and this one's tough because, you know, Congress and the President reached a budget deal probably, about a month ago. And
Right.
One of the things that they did not do is they didn't do 2 big things. One, they didn't extend Section 179 depreciation so that could be up to $500,000 like it's been in the past. The other thing that they didn't do is they didn't use the popular strategy. They didn't extend the popular strategy of being able to contribute to a charity straight from your IRA. Now, a lot of pundits, if you read things like Kiplinger and other sources, they believe that this is still going to happen by the end of the year. But as of right now, it hasn't. And so we've got, today is November 30th, we've got 31 more days after today that Congress can put this into place. But what, and I still, because they, a lot of pundits believe this is going to happen, I think it makes sense to talk about it. But that is the provision where IRA owners who are age 70 and a half and older, what they can do is they can make an IRA, they can make a contribution of up to $100,000 directly to a charitable organization. And if they do that, they can exclude that from their modified adjusted gross income. So again, this is a very beneficial strategy.
Brian, a question came in. Does the check have to be written by 12/31 or actually clear the institution, the bank, the brokerage account, wherever it's being written from?
It needs to be written by December 31st. Doesn't have to clear. It needs to be written by December 31st. Has to be postmarked by the 31st as well. And so many times the charities will help you out with that as well. But it needs to be written by December 31st. Now, as I say that, you're talking about charities, and I'm sorry as I slow down and be put on the spot with this, it needs to be received by the charity by December 31st.
Okay.
It needs to be received. So you need to make sure that if you're giving to your church or whatever, that they have gotten that check, that they have gotten it. But it does not go by when it's cleared.
Okay, we're told contrary from TD Ameritrade on that specific issue. We're actually having clients call the week between Christmas and New Year's to have the charity make sure they cash it, they clear it.
It's not so much that they have to have cashed it; they need to have received it.
Okay. Okay.
So, for example, if you go to your church's New Year's Eve service and you put money into their offering plate on New Year's Eve, they've received it at that time, but it won't have cleared the bank, of course, until 2016. But as long as they have received it by December 31st, you're in good shape.
I think it's so wise just to say get working on it now versus waiting to the New Year's Eve service.
Absolutely.
So,
Absolutely.
Yeah, we have a couple clients where we're calling them saying write your checks. So yes.
So let's go back to the idea of the IRA charitable rollover. And again, we believe that this is going to still happen before the end of the year. Why is this better than just taking money out of your IRA and giving it to a charity? Wouldn't that work just as well? Well, not necessarily. Well, first of all, by taking money straight from your IRA and giving it to the charity, it does not cause your Social Security to be taxed. Whereas if you've taken money out of your IRA and then given it to charity, that's going to cause your Social Security to be taxed for someone who's receiving Social Security. The other thing it does is it does not cause your medical expenses and other itemized deductions to be limited due to a higher amount. So, for example, if you are subject to medical expenses which get a deduction of the amount greater than 10% of your adjusted gross income, this would not affect it at all. Also, if your itemized deductions are limited because of your high income, by giving it straight out of your IRA, it does not affect that. The third thing, is that it may satisfy the required minimum distribution for the year. So again, it's a way to get money out of your IRA that necessarily you would not have needed to use. So let's use this as an example. We've got Bob. And Bob gives his church $50,000 directly from his IRA, so he pays no tax on this amount. Now, if Bob is out of his IRA and given it to his church, it would have caused his Social Security to be taxed, and would also have increased the threshold to deduct his medical expenses, and it would even have limited his charitable deduction for the year. Because again, Bob's in a situation maybe where his income is not very high because he's in retirement years, but yet this is something he wished to do. It would have limited his charitable deduction for that year. Okay. Next strategy that we like, and I know this has always been a big strategy that you like to use, Rob, and that's the idea of gifting appreciated stock. And by gifting appreciated stock to a charitable organization, what you do is you receive the fair market value of the stock as a charitable deduction. So let's say you had a stock that was worth $100 a share and you bought it when it was worth $10 a share. You're going to get a deduction for it being at $100 a share. And why is this better than selling the stock and giving money to the charity? Well, it's the same thing that we just talked about. By doing this, you don't have to pay capital gains tax on it. It's not going to cause your Social Security to be taxed. It's not going to increase your threshold for the medical expense deduction. And as well, and this is something that's not true on the IRA side, at least in Illinois, because Illinois IRAs are not taxed, but state income taxes won't have to be taxed if you give away appreciated stock rather than sell it and give the proceeds to the charity. So lots of reasons to give appreciated stock. Now, the next topic that we like to talk about is the net investment income tax. And what happens with the net investment tax is this comes into play if someone's adjusted gross income exceeds $125,000 for married filing separate, $200,000 for single and head of household, and $250,000 for married filing joint folks. Now, these thresholds are not adjusted for inflation. So these are going to remain there. This is what they were last year. This is what they'll remain as Congress has written the law now, how they'll remain for going in the future. If we can avoid this tax, that would be always a good thing. Now, one of the things, and I think we got our slides a little bit mixed up here, and I apologize for that, but one of the things we wanted to talk about, and I'm just going to go back to this, so disregard what I said for a moment on net investment income tax. Let's go back to charity for a second. One of the things that I know Rob is a big fan of, and I think is a good thing as well, and that's the idea of giving to a donor-advised fund. Because what happens if you've got a large appreciated stock that you want to give to a charity, but the problem is you don't want to gift that stock to just one charity, you'd actually like to gift it to multiple charities. Well, one of the things that you can do is gift that to a donor-advised fund. And what happens with a donor-advised fund is it's set up with an organization. There's lots of organizations out there that Rob can put you in touch with. But what they do is that you make a gift of that appreciated stock to that organization, and they set up a fund for you, and it would be like, for example, we have there the Smith Family Fund or the Odell Family Fund or whatever the name you would like it to go to. You set it up in your name, and it's your family's fund that you can use to gift money to various organizations. So what you do is you gift this large this highly appreciated stock to this family fund, and then what happens is then from there you direct it to giving it to the church or the various charities or various charitable projects as you would be so inclined. So again, that is how a donor-advised fund operates. And again, the beautiful thing about the donor-advised fund is that, for example, I might have that I don't feel comfortable giving a large amount to a particular organization, maybe it's a church or whatever it is, this year. I want to give something. What it does is it allows me to hold that money into a fund, and it allows me to give that money in the future to an organization. Now, Rob, I know one of the big things that you're big on, and I'll let you talk about it because I think it's a great idea, and that's the idea of bunching tax deductions. And a donor-advised fund allows you to bunch tax deductions. And why don't you talk about that for a second, Rob?
Right. We have clients who have a spike year of income, let's say. Let's say their income is going to be close to 7 digits, and normally it's in the low 6 digits because of stock options exercised or a bonus that was paid to them. We will go ahead and hopefully they have appreciated stock, but if they don't have appreciated stock, we will prepay their charitable gifts 4 or 5 years in advance. We've do this quite frequently. Another client who's retiring next year, so income is significant in 2015, 2016, will be in the 15% bracket. we're having him give 5 to 7 years of charitable gifts of low basis stock to his donor advised fund, get the income tax deduction in the year in which he needs it, and then as future years go on, when he does not need the income tax deductions, he can just give out of his donor advised fund to his favorite charities. So there's all sorts of applications for donor advised funds that we use. We'll also match it up with Roth conversions. So if we have someone who's going to convert to Roth, they're going to have a sizable income tax in the year of conversion. We'll also have them do a donor advised fund to take some of that sting of the ordinary income tax that they would have to pay.
Yeah, so those are great ideas, and that's one of the things that make a donor advised fund just a wonderful tool to be used. That brings us now, we were talking about the net income tax, that brings us back to the net investment income tax. So with the net investment income tax, it's on page 2 of the tax return, and sometimes it's referred to as the Obamacare tax because this is something that was implemented to help pay for the Affordable Care Act. And so what it is, it's a tax that's 3.8% multiplied by the lesser of the net investment income, or the modified adjusted gross income in excess of some of those previous thresholds that we had back a couple slides ago that were here. Let's see if I can go. There we go. That were $125,000 for married filing separate, $200,000 for single and head of household, and $250,000 for married filing joint. There we go. The next question is, well, what is net investment income? Well, it's going to be net gain from property held for investment. So again, this is going to be stocks, bonds, mutual funds, real estate, etc. Again, another reason that to use donor advised funds or to give away appreciated stock because again, it allows you to avoid the net investment income tax. Capital gain distributions from mutual funds are going to be included in net investment income. Dividends and interest are going to be included. Rents and royalties are included in it. All of these, if they're above that threshold, are going to be subject to that 3.8% tax. Annuities, gross income from a passive business, and also any gains you might have on a principal residence that's been sold. The gain is greater than $250,000 to $500,000. So what is non-investment income? We talked about what is net investment income, what is not. Well, wages and self-employment income, that doesn't count. Non-passive business activities, that doesn't count. Distributions from retirement plans like your IRA or your 401k plan. Tax-exempt interest. Those things are not net investment income. Neither is your Social Security benefits or unemployment benefits. Alimony doesn't count. And neither does your regular gain of less than $250,000 or $500,000 if you're married on the sale of your principal residence. So here's an example. Is we've got Ima and you are rich. They're married with modified adjusted gross income of $275,000. And they've got net investment income of $50,000. They're going to owe net investment income tax that's going to be based on their modified adjusted gross income. That's the $275,000 less the $250,000 because they're married times 3.8%. They're going to owe net investment income tax of $950. Or here in this example, they've got adjusted gross income of $375,000 and net investment income of $50,000. So they're going to be taxed on the lesser of the threshold or the net investment income, which is 3.8 multiply it by 3.8%, and it's $1,900. So again, this is extra tax that they're going to have to pay. And again, it's one thing to pay income tax. But remember, if you're making in this $375,000 in this example, or $250,000, you are already in a very high tax bracket. So this is getting dinged again on top of it. It kind of almost adds insult to injury if you've been subject to it. So what are some ways that we can avoid the net investment income tax? And this doesn't just avoid about the net investment income tax, but also maybe as a way to avoid or to reduce regular income taxes. And one way that we can do that is by having an installment sale. And the installment sale has a method of spreading income over 2 or more years, and therefore you reduce your adjusted gross income so it doesn't exceed the threshold amount. So here we've got an example. We've got Rob and Janine. They're a husband and wife. They file a joint return, and they have an investment property. And in 2015, they're going to have a long-term capital gain on that of $500,000 on this. So if they have no other income, which we know is not going to be the case because they are going to have other income, but if they have, let's say they have no other income, they're going to have net investment income tax of $9,500 on top of long-term capital gains. So if they structured this as an installment sale that's payable in 2 equal installments of $250,000, then in that situation, they wouldn't have to pay any net investment income tax in 2015 and most likely again in 2016. So again, just a way to avoid or at least reduce the net investment income tax. The other thing that they can do, another strategy that they can do, is do a like-kind exchange. What happens with a like-kind exchange, you might have heard of this referred to as a 1031 exchange. But what happens with that is that there's no gain or loss is going to be recognized when the property is held for productive use in a trade or business when it's traded in exchange for like-kind property. And again, this strategy doesn't just avoid the net investment income tax, it also defers capital gains tax. So, and again, another thing to avoid the net income tax is Roth IRAs, because again, qualified distributions from Roth IRAs, they're not included in adjustable gross income or net investment income tax. However, remember that distributions from traditional IRAs, while they're not necessarily included in the net income tax, they are included in adjustable gross income and could cause that net income tax to come into net investment income tax to come into play. The other thing to do is timing your transactions. A transaction can be timed to take place when the adjusted gross income is expected to decline. And of course, it's a great idea to time a transaction, but it's not always practical. So let's use this as an example. We've got Gary and Marina. They're planning to retire in 2015. Gary considers he wants to sell his Apple stock. If he considers waiting to sell his Apple stock, which has a $250,000 gain, he might wait till a year where he's in retirement, not in a year where he is retiring, where he's got income from wages. And if he does that, he's going to do that in a year in which his adjusted gross income could be much lower. So with that, that concludes my presentation. I don't know if you have any questions or comments that you want to add to that, Rob?
Just got a question coming in. How does the charitable deduction lower adjusted gross income as relates to the net investment tax?
A charitable deduction will not lower, a charitable deduction on its own will not. However, if you give appreciated stock, and what that does, as opposed to selling the stock and giving it to a charity, if you sold the stock, well then you'd have net investment income tax on it. But if you gave it directly to the charity, there would be no net investment income tax, so you'd be getting a deduction, plus you wouldn't be paying any capital gains or net investment income tax on that stock. Does that make sense? Was I clear on that, or was I a little bit talking in circles?
You know, when you're doing the planning, there's so many different numbers we're looking at and different rates. So you have adjusted gross income, but then you have taxable income, kind of above the line, below the line, and it makes it very difficult. And often, as advisors, you and I see many inefficiencies where the client or the person's advisors are not communicating together. And it's important that someone has a plan going into the year. So right now, 2015 is pretty much under the water, but we're actively planning our clients' 2016 and 27 tax returns, so there's no surprises when we get there.
Sure.
I have another question coming from Naples, Florida. What's the payment in the year of a contract sale greater than the gain? So if someone is selling a property on contract,
Okay.
How are they taxed on it? Is it in the year in which they sign they sell it, or in the year in which they receive the payments?
It's going to be the year in which they receive it. If I'm following the question correctly, let me try to put this as an example and make sure that I'm following correctly. Let's suppose I've got a house, a rental property that I'm selling, and let's say I've got it under contract to sell. It's been sold, but I've not received any money in 2015, but I don't receive the money until 2016. I don't pay tax on it until I receive the money.
Here's a follow-up question to that. If someone sells a property, in this case, investment property, for $1,150,000, and in the year which they write the contract, they receive $500,000 as a down payment, and then the $650,000 over the next 5 years. How's the taxation on something like that?
Well, that's now becomes an installment sale. And so what happens is the $500,000, what you would do is it would somewhat depend on what your basis in that property is, but it would be that that property, you would recognize the gain, you'd recognize a portion of the gain. Let's bring this. Let me bring it back to another one. Let me bring it back to an easier number. Let's use $1 million, just a flat $1 million, and let's say $500,000 is received this year, and the remaining $500,000 is received over the next 5 years. You would recognize 50% of the gain in 2015 because you received half of it in 2015. You'd recognize the remaining amount, $100,000, the remaining 10% per year over the next 5 years. Does that make sense, or did that clear it up a little bit, or did I confuse it more?
No, yeah, I got a thumbs up from the person who asked it, and I think you made him or her very happy in that answer.
Good, okay.
Here's another question I have that just came in. I sold a secondary property, and my gain was around $75,000. I have already taken $500K on prior residence sales. Any thoughts on how to minimize the tax? It sounds like in this case, the water's under the bridge, but someone who's already made a property sale in 2015.
Yeah, it sounds like it is too. If they've already sold it, unfortunately, there's maybe not a whole lot that they can do on it.
Yeah, it's unfortunate.
I probably would need to know some more of the facts and circumstances, and if they wanted to contact me, I could maybe help them, but it would. I doubt if there's a whole lot they can do.
Yeah, it's unfortunate. There might be some charitable giving this year to take a little sting out of that, depending on what their overall picture looks like. Any other questions? We're just about wrapping up here. I guess not. So I'm going to conclude this. Brian, I want to thank you for the 3rd year in a row in doing our year-end tax planning webinar. I hope you come back next year. And
thank you so much, Rob.
Do it again. This concludes our webinar series for 2015. This specific program has been recorded, and shortly here we'll have it on our website for you to listen to. You're welcome to forward it on to family, friends, others who might be benefited by this. And look forward to seeing our slate of webinars coming in 2016. We have some pretty exciting ones. We're just nailing down to the specifics in terms of date and times, but we'll be announcing those very shortly. So again, Brian, thank you. Appreciate your time today, your expertise, and specific questions to yourself, feel free to email me. I can forward it on to Brian and be happy to get an answer for you. So thank you.